Buckle up, everyone. You are strapped in and ready for Insurance Hour with me, your host, Karl Susman. Informing, educating, and entertaining, one policy at a time. This is Insurance Hour. Hello. This is Insurance Hour with me, your host, Karl Susman. Thank you so much for being here today. Remember, this show is brought to you by the generous support of ICGS, the Insurance Consumer Guidance Society. Their plan, their goal, their only goal is to help you understand the insurance industry. Utilize your policies, understand your policies. What in the world is it you need to know about insurance these days? That is what their goal is, to help you understand that. So please visit icgs.org, give, sponsor, stay in touch, sign up for newsletters, all that good stuff. Without their support, there would be no Insurance Hour. And with that, let me remind you, if you want to reach out to me directly on the Insurance Hour program, you can call me direct at 559-656-0317. That is phone or text, or send your questions in to questions@insurancehour.com. And as you can imagine, go to insurancehour.com and find all the information you're looking for there as well. All right, with that housekeeping out of the way, we've got a full show, so let me jump right in. This hour, we are going to talk about everything from the homeowners insurance crisis in California, Proposition 103, wildfire, home hardening mitigation, fair plan, you name it. We're even going to talk about some scams that are out there on roof damage, as well as some auto insurance issues that are going on as well. So let's just start right in. Now, you might have noticed, if you're living anywhere in California, that getting homeowners insurance is, well, how do I say this? Very difficult, very complicated, and very expensive. And on top of that, your choices are slim pickin'. So how did this happen and why did this happen? I'm going to sort of summarize or oversimplify really what it is that's happened, but let me try and do that to make things easy so we have a common frame of reference. In California, there is no mandate, meaning there is no particular insurance company that is mandated, meaning they must offer homeowners insurance. It's voluntary. So a private company can come in, file papers with the Department of Insurance, get approved, and they can offer coverage based on the guidelines and the underwriting and the prices and the modeling and whatever the case may be to offer that policy. If your home happens to be in an area that all of the companies look at and say, I don't know about that one. It looks a little bit risky. I don't think I can take the exposure for that, or I don't think I can get enough premium to cover the expected losses of that property, then the company will pass. They don't have to offer you coverage. Now, this is really the way it works in pretty much every market for the most part. Companies aren't forced to, potentially lose money, competition, private industry, all that stuff, right? You offer a product and you hope people buy it where you want to sell it. So in California, because there are areas now, specifically as time goes by, that are being identified as being such a substantial risk for wildfire, for example, homeowners insurance companies, condominium owners companies, renters companies, all of them have found that there are some areas that they simply cannot insure. Now, that's always been the case. The difference is that now those areas are expanding. Whereas it might have in the past been in the middle of the hills, somewhere far, far away, somewhere that did not impact a significant number of people. And there was a way to fix that. There's a way for those people to still get coverage. I'll cover that in a moment. But now those areas are increasing in volume. So it's impacting more people. So historically, if someone needs to get coverage, they have a home, they have a property they want to insure, and their private industry does not want to insure it for whatever the reason might be. Like I said, can't price properly, can't underwrite properly, or the likelihood is simply too high. The actuaries say, you know what, the likelihood of this property having a loss is just too high for us to take that risk. Then they would go to the state organized California Fair Plan. The Fair Plan is a conglomerate that private industries are forced to participate in and basically offer basic fire insurance. So in essence, you might go to an insurance company. Let's say you go to 5 companies and they all say, nope, too much risk, can't take it. Then you go to the California Fair Plan. Well, the Fair Plan is going to offer that basic fire coverage, and those companies that said no before are all going to be chipping in and paying to be sure that the California Fair Plan has enough money to pay claims should the premiums they charge not be sufficient. So it's a little bit of a strange situation that we have, but it's historically worked all right. Because in the event of losses, the California Fair Plan either has sufficient premium that they're able to pay the claims, and on occasion, if they run out of money, the insurance companies, the private carriers that participate, they will turn around and offer the additional money that they need. I say offer like they're happy to do it. They'll give the money that they need in order to close that gap and pay those claims. So that's what companies have been doing, and that's what we've been seeing. Now, why has this gotten worse? Well, we have had a significant increase in the severity and the frequency of claims happening in California. First, we had something called non-weather water losses, and what that is a fancy way of saying is pipes were breaking, homes were getting older, people were not maintaining them, and water damage claims were becoming a real problem. This is back maybe a decade or so. And this became a problem because those old galvanized pipes started to leak. Some of the newer homes were built on slab, so the pipes were actually in the concrete, not under the house, under some type of crawl space. So imagine if a pipe breaks and your house is on a raised foundation, somebody can get under the house, they can find the pipe, they can replace it, and you move on. But if those pipes are actually embedded in the concrete, in the slab of your home, you can imagine how much money, how much damage has to be made in order to get in there and fix it. So non-weather water damage claims started to skyrocket as homes were getting older, and homes that were built on slab construction were creating expensive claims when those water damage claims were happening. Now, I would say the industry sort of figured out a way to deal with that. They started incentivizing people by discounts to get updated plumbing. Some were mandating it. So as time went by, that became less and less of a problem. They also came up with special deductibles where they'd say, look, you're either going to have a larger deductible if it's a water damage loss, or we're not going to cover water damage unless you update your plumbing first. So lots of little things got done over time, and the non-weather water claims became not as much, although industry folk may argue, became not the highest concern or the highest priority to fix. Wildfire became the real problem, because what we started to see, and we'll talk about this more in the next section, we started to see wildfires happening instead of every few years during quote unquote wildfire season. We started seeing it happening pretty much year round, and big ones, big fires. Let's talk a little bit about wildfires and how that has impacted the industry. First, let's take a break really quickly, hear from our sponsors once again. This is Insurance Hour. I am Karl Susman. We will be back in 60 seconds. Don't go away.
Insurance Consumer Guidance Society, ICGS. Independent, accessible, empowering. Educating Californians for smarter insurance choices. The Insurance Consumer Guidance Society, ICGS, is a 501c3 nonprofit organization dedicated to providing the residents of California with clear, unbiased educational resources about insurance. Our mission is to enhance consumer understanding of insurance products and the evolving regulatory environment, particularly in light of challenges posed by climate change and market shifts. ICGS provides comprehensive insurance education, public and media outreach, and direct consumer support. ICGS serves the public by fostering informed decision-making in a dynamic insurance landscape and empowers Californians with the knowledge they need to confidently navigate their insurance choices. To learn more about how we can serve you and find free resources, visit us online at icgs.org.
Hello. This is Insurance Hour with me, your host, Karl Susman. Thank you so much for being here today. We are talking about, you guessed it, insurance. Don't forget to visit our sponsor, ICGS. That is the Insurance Consumer Guidance Society at icgs.org. Without their generous support, this show would not be possible. I would not be able to be here helping give you this important information. Visit icgs.org. Sign up to be a supporter. We need your support to keep this show going. Now, before the break, we were talking about the explosion of wildfires in California and how that is impacting the homeowners insurance market. Now, unless you're living under a rock, I think I've already said that once today, but a lot of rocks to be living under apparently, you may have noticed we are having massive wildfires in California. And not just in those mountainous areas that we'd see before. We're seeing them in local, middle of the city areas that we were not expecting to see wildfires. And more specifically, those wildfires spread like, well, excuse the pun, wildfire. This most recent fire that we had in California, there were two major fires that we're looking at right now, the Palisades fire and the Altadena or the Eaton fire. Now, these fires were unique because they were not just fires that happened. They were fires that happened under certain conditions that created an environment where those wildfires spread so quickly and so drastically, areas that were never thought to even be near, not even adjacent to areas that would burn in a wildfire, not only took damage, took heavy damage, and most of the time were total losses. So now, areas that we once thought were safe, not so safe when it comes to wildfire. So what does the industry do? What does an insurance company do when all of their planning, when all of their, I call them the big brains, when all the big brains get it wrong because they did not know, they did not plan for these areas to get hit? Well, the first thing they do is stop writing new business. And that's what we saw happen initially. Insurance companies stopped writing new business basically to regroup, to sit around at the boardroom and say, okay, this isn't good. We have to figure out a way to be able to have money to pay our claims. And we're not priced adequately. We're not able to properly underwrite, pick and choose, make recommendations, make mitigations mandatory, things like that. We don't have the ability to do those things. So there's no way for us currently to be able to turn around, continue business as usual when it is not environment as usual. You can't have business as usual when it is not claims as usual, to make it simple. So the industry stopped. Now, those are companies that are regulated by the California Department of Insurance. What happened next are carriers that were not licensed to do business in California. These don't necessarily, that doesn't mean, oh, these are bad companies, they're illegal companies. No, I've actually heard them referred to as illegal companies. They're not illegal companies. These are regular insurance companies that simply do not participate in the process to go through and offer coverage in the state of California. So they are not specifically admitted, which also means they do not participate in the California Fair Plan, which also means they don't have to follow all of the same guidelines, rules, regulations that the California Department of Insurance puts on there. Now, they also are not covered by CIGA, CIGA, which stands for the California Insurance Guarantee Association. This is an organization where if one insurance company that's admitted in California goes belly up, all of the other member companies will chip in to help shore up the claims that are outstanding to certain limits and be sure that consumers do get some money. So a non-admitted company does not provide that additional safety net, if you will. They stepped in and they said, okay, because we're able to quickly change our guidelines, we're able to quickly price for what the new norm is, they jumped in and started offering coverage. So all of a sudden you might have had a policy with company A and they were admitted and they were charging you X dollars, but now that company was no longer offering new policies. So when you went to buy a new home, or maybe your home was coming up for renewal, you were non-renewed. Now you had to start looking around. Well, since none of the standard, air quote standard, admitted companies were offering coverage, you might have gone to a non-admitted company, also known as a surplus lines company, right? You might have heard these terms. They're all fairly synonymous. Now, guess what? In addition to being able to have that flexibility to underwrite and to price and to basically do whatever they want with their policies, these companies tend to be more expensive. And they are because they're not held down to the same type of competition, the same level playing field, if you will, that other admitted companies are with. So whereas you might have been paying, let's just say $1,000 for your policy with an admitted company, and all of the admitted companies, let's just say, were in the range of $800 to $1,200, right? You were right in the middle, around $1,000. Now that company stops offering coverage. You have to go to a different marketplace entirely, right? You're no longer looking in the admitted market space. You're in the non-admitted market space. Now that premium could be $3,000, it could be $5,000, it could be whatever these companies decide they want to charge. Again, they're not admitted. They are not bound by the same guidelines. They don't have to prove anything, basically. It's a pure market-driven, I don't want to say free-for-all because that gives it a bad connotation. Let's just say they're able to do what they want and they do jump in when the rest of the market is unavailable. And they did. So a lot of people were moving from admitted insurance companies where the prices and the products were no longer keeping up with the standard new reality, I guess you could call it, to non-admitted companies that had not only taken these new risk factors into consideration, but, and again, I don't mean this derogatorily when I say took advantage, but they jumped in and they said, okay, we can do what needs to be done, but since there's no real competition right now, we're going to charge the premium that we think that we can compete with. Now, competition among non-admitted insurance companies is different than competition between admitted companies because their products are not in any way similar. So it's a lot more difficult, even for a licensed insurance professional, to look at an insurance company's policy on a non-admitted basis and compare it with another insurance company's policy on a non-admitted basis. They can make slight, subtle changes that you might never notice unless you actually comb through every single word of the policy, and that's just not normally how it's done. So what's happened then? We see people, let's look at the bottom line. The bottom line is what they are paying in their insurance premium went up, and it went up significantly. Some people that remained with admitted insurance companies, those insurance companies filed new guidelines, new rate requests, new changes to their product and policies with the Department of Insurance, and although it took, unfortunately, sometimes over a year to get those through the system, more on that later, they finally did. So instead of paying, let's say, that $1,000 with the admitted carrier, maybe now you're paying $1,500 or $1,600 with that admitted carrier. You're not happy, but it's better than the $4,000, $5,000, or $6,000 with the non-admitted company. Hopefully that didn't confuse you too much. We'll try and pivot to something else after this break. Insurance Hour with me, your host, Karl Susman. 60 seconds. Be right back.
Insurance Consumer Guidance Society. Our mission is to enhance consumer understanding of insurance products and the regulatory landscape in which they operate, particularly in light of mounting challenges that many consumers have faced, such as natural disasters and significant market shifts. These factors have contributed to an increasingly volatile insurance marketplace across California. ICGS is there to help. Please visit our website, icgs.org, and help support the nonprofit that's there to support you. Through education, engagement, and direct support, the Insurance Consumer Guidance Society strives to be a steadfast ally and resource for California consumers today and in the future. Visit our website now to support us at icgs.org. Once again, our website is icgs.org. Insurance Consumer Guidance Society. Educating Californians for smarter insurance choices.
Hello. This is Insurance Hour. I am your host, Karl Susman. Thank you so much for being here, talking and listening to my favorite insurance topic, insurance. Insurance. My favorite topic of insurance. How's that? Hey, listen, don't forget, you would not be able to be learning from this show without the generous support of the Insurance Consumer Guidance Society. ICGS.org is the website. They are the ones responsible for us being here. They are the ones that enable us to get this information out to you. So please, visit icgs.org, sign up for updates, sign up to be a sponsor. We need their support to keep this show going. Therefore, we need your support. So please visit icgs.org and help us out. Okie doke. Let's move on from homeowners insurance and that shock that we were feeling as a lot of the industry was trying to shuffle between the old and the new. And let's talk about why is it that it taking, depending on your perspective, years and years for these things to happen. Well, the first thing is we have to understand that in California is a very highly regulated state. It's very hard to get things changed in the insurance industry. It's not as if you can say, hey, you know what? BMW changed the price of their car from, $75,000 to $80,000. Therefore, we have to charge a higher premium to insure the car. Well, that makes sense, right? If before you had to cover a $75,000 car and now it's an $80,000 car, it would make sense that you might need to charge a higher premium for that, right? But something as simple as that, because of the way the regulations in California are, specifically Proposition 103, which dictates the vast majority of those laws, more on Proposition 103 later, that type of a change could take a year. Sometimes it could take well over a year. I'm aware actually of a couple of requests that were put in, and they were actually discount requests from insurance companies that sat for over 400 days before they were approved with the Department of Insurance. You might be asking, well, what in the world? It's a discount. Why don't they approve it? Well, if you get and pull behind the curtain, you're looking at layer upon layer upon layer of bureaucracy. And on top of that, you have a system where if a third party, meaning I guess you could call it somewhat of a shadow insurance department, doesn't like something, they can turn around and gob up the gears and slow it down even more. So things tend to sit a long time. So you can imagine, again, taking that example, if you've got a car that was $75,000, now it's $80,000, the insurance company says we have to charge a higher premium because the price of the car went up, and they don't actually get to the place where they can charge that higher premium for a year or two. Maybe that car has gotten even more expensive by now. But in the meantime, money's being lost every time a claim happens with that car. Now maybe the car's value goes up again and they start selling it for more. You see how this starts to pile up on itself. We reached a tipping point where there was more money going out in claims than there was premium coming into the insurance industry in general. Not a good thing, and obviously not sustainable. Insurance companies, not nonprofits like ICGS.org, right? The company that the organization, the nonprofit you're going to support and visit to help support so we can keep our show going, they're for profit. They have to make money. So if they're paying more in claims and expenses than they're collecting in premium, the whole thing falls apart. So let's talk a little bit about why that does happen. I mentioned something called Prop 103 or Proposition 103. So it's fair for me to give you a little bit of history, just a little summarization of what that is. About 30 plus years ago, there was a problem, as we had earlier discussed, non-admitted companies. If you missed that, go back and listen to it because I think I gave a fair explanation. There was a problem with non-admitted auto insurance companies and some really bad actors. They were doing bad stuff. I don't have to sugarcoat it. I'll just tell you, bad stuff. Stuff you do not want to be doing. Stuff that is highly unethical, borderline illegal. I don't know if I can say that, but perhaps that is fair. So because of this, we were seeing auto insurance rates that were way out of whack, way out of control. And the guidelines and everything that was going on was just creating havoc in the industry. So in order to try and fix that, because the public perception, rightfully so at that time, was so poor, and the way things were going on and the way these auto insurance carriers were really doing bad things, there became this movement to try and update insurance regulations. This became a proposition that an organization created, and that organization created, it was known as Proposition 103 because it was Prop 103. That was the number that happened to be assigned to it when it was put on the ballot. Now, this proposition did a lot of things, but in essence, the main things that it does, I should say, because it is still the law of the land in the state of California, is it created an environment where insurance carriers could not do anything without some level of approval before they did it. Whether it be adding a discount, whether it be raising a rate, whether it be changing the way they underwrite or how they decide what's a good driver or what's a bad driver or what's a good home policy or what's a policy that's in the brush area, what do they do if there's claims, you name it, it was impacted by this proposition. Interestingly enough, the proposition was sold with a strange buzzword. Sort of the mantra of it was 20% off on your auto insurance. And basically what it did was it said, hey, you know what? We're going to promise you that if you vote yes for this, we will get you 20% refund on your current auto insurance policy. That was really how it was sold. And of course, you look at that and you're thinking, well, if the average consumer sees a proposition that says, hey, vote for me, and or not me, vote for this and I'll give you 20% back on your current auto insurance, and it's in the environment where auto insurance carriers are really doing some bad things, you can see how that might be pretty attractive to people. They're going to think, well, we're going to finally get some money back. We're going to probably try and get these rates lowered. So people voted for it. Interestingly enough, even in the horrible auto insurance and insurance environment in general that was going on back then, even though all of that was going on, and even though it was promising 20% off of your auto insurance, it still only passed by a small margin, by 1% of the vote, which I always thought was interesting because it sounds like a no-brainer. If that's what it is, heck, who wouldn't vote for it? But it passed by a very, very slim margin of about 1%. And since then, it has been, like I said, the law of the land, which has created an environment where we have a Department of Insurance that we vote for the commissioner. We put the commissioner in. He's reelected every 4 years. If we don't like him, we get rid of him and pick another one. But it also created an environment where any third party, anybody, you or me or an organization, could also step in if they didn't like something that an insurance company was doing, which effectively created an environment where insurance carriers, anytime they wanted to make a change, it would take months and months and months to get through the process. A little more after the break on this, then we'll move on. This is Insurance Hour. I am Karl Susman. You are standing by.
What if your insurance failed you tomorrow? A wildfire, a burst pipe, a car accident. Most people think they're covered until they find out they're not. And that's exactly why the Insurance Consumer Guidance Society, ICGS, exists. We are an independent, nonprofit organization helping Californians understand their insurance before disaster strikes. No sales pitch, no corporate agenda, just clear, unbiased guidance from licensed experts who work for you, not the insurance companies. Whether you're a homeowner, renter, or a business owner, ICGS helps you navigate premiums, exclusions, deductibles, even California's complex wildfire and hazard requirements. Because the biggest risk isn't the disaster itself, it's not knowing what your policy actually covers. Visit icgs.org to get free education and support. And because ICGS is a nonprofit, your donation helps keep this vital service free for Californians who need it most. ICGS, empowering Californians to make informed insurance decisions.
Hello. This is Insurance Hour with me, your host, Karl Susman. Thank you so much for being here today and learning about insurance. Don't forget, this show could not be made without the generous support of the Insurance Consumer Guidance Society. ICGS.org is the website. Please visit them. Please become a supporter of the show and of the program. We would not be able to keep this show coming if it were not for their generous support. We thank everyone at ICGS, the Insurance Consumer Guidance Society, for helping us bring you the most accurate, unbiased update information we can on the insurance world in the state of California. Before the break, we were talking about Proposition 103, some of the things that it impacted, everything, and how it trickled down to consumers. Well, let's just make it easy. At this point, we're talking about regulations, about laws, about a proposition that was put into place over 30 years ago. Do you think that things have changed in the last 30 years in our world? Do you think technology has changed? You bet. Do you think that the way we can predict losses has changed? You bet. Has vehicle safety changed? Absolutely. Has construction type changed? Yes. Has it changed where people have moved? Do people live in different areas, different parts of the state than they used to? Absolutely. So there's been lots and lots and lots of changes. Unfortunately, Proposition 103 has remained pretty much unchanged during that entire time. What we've been left with is an environment where, as I mentioned previously, everything moves so slowly that when you're in an environment like we're in right now, where number one, we have so much access to data, and we have, again, such a change in the actual environment of claims and the cost of claims, that we have this collision between old regulations and the new world, the new reality that we're living in. So there have been some potential changes being proposed to Proposition 103, some new interpretations to parts of it. And because of that, we are starting to see the insurance industry finally be able to step back in, the admitted insurance carriers in the state of California, to try and get a little bit more dipping their toes in, let's say, and hopefully in the next few months we'll start to see them actively participating and actively writing business, and what we really want, get them all back here and competing. Because when insurance companies compete for business, what does that do to the rates? It lowers them. That's why the rates are high right now, because we have very little competition. All right, let's move on from that. So with this new normal, with this new environment, pun intended, what is it that we can do to try and lower our insurance premiums? What can we do? We can't change the weather. We can't change the climate change. Well, we can, but you know what I'm saying. We can't change it tomorrow. We can't make all of this be turning on a dime. So what can we do? Well, what we are doing now, what we need to be doing are two things. We need to look at the insurance policy that we have differently than we used to. We used to look at it as, well, it's a policy. We have it. If there's anything that ever happens to anything I have insured, I put in the claim, I get it taken care of. That's how we used to look at insurance. We need to pivot a little bit and realize that insurance policies are not warranty policies. They're not maintenance policies. They are really there in the event of something catastrophic happening. That's what we should be utilizing insurance for. What does that look like in practical terms? It means, well, we should not be sitting with low deductibles for our home insurance or our car insurance. Keeping a $250 or a $500 or at bare bones $1,000 deductible on our auto insurance is where we need to be looking, because you are very likely not going to see anything that's going to happen with a lower with a lower amount of damage than that. If you have a relatively new car and you have any type of physical damage in an accident, the chances of it being under $1,000 closed 100%, slim to none. So why are you carrying that deductible? Because remember, the lower the deductible, the higher the premium. Not to mention that, again, because of Proposition 103 and the definitions that it and mandates are used, once you have filed that claim, your rate will be impacted fairly dramatically for a period of time. So once again, we need to look at our insurance policies more as something that we use in the event of something really bad happening, and not just, well, will this get covered? Then I should get money for it right away. I should file that claim right away, because it all comes back. The environment is such that carriers are going to have to recoup those, I'm making air quotes, smaller losses versus those larger losses faster. So auto insurance, what can you do? You need to keep higher deductibles, and remember, insurance is there for the big stuff. It's not there for the little scratch. The little scratch, unfortunately, you want to just go and write that check. And if you can't, then you drive around with that little scratch. I'm not trying to be insensitive. Look, my car's got some scratches on it. I actually recently got a new car earlier this year, but before that I had a 6-7-year-old car, and it had some scratches. It had a little bit of a bump here that someone who drove it, not saying any names, not me, did when they were parking. And you know what? I could have just gone and fixed it. I thought, what? It's just a car. It's going to have the scratches, and I just sort of dealt with it. That would not be something I would want to put a claim in for, and it wasn't something that I thought was worth paying out of pocket either. Make those decisions, have those discussions at least, and understand, again, you don't file a claim just because you immediately say, hey, this could be covered, and you file the claim, because there are financial ramifications to that. Now, as far as your property insurance goes, what can you do? You want to make your house look as attractive to insurance carriers and Mother Nature as possible. Meaning, you want to do things to make your home less likely to burn. It's called home hardening. What does that mean, home hardening? Well, it means it makes it harder for your home to have a loss. What does that look like? It looks like everything from clearing anything that's close to your house that could burn. That could be a fence, that could be vegetation, it could be a tree overhanging the roof. I mean, we could do an entire show that talks about nothing other than home hardening. Perhaps we will. there was some movement for something called Zone 0, which would have mandated homes have a minimum of 5 feet between the structure and anything combustible. Turns out that regulation, that did not pass. And it's interesting because I remember driving around and seeing people had lawn signs on their front lawn that said, "Hands off my landscaping, Zone 0 doesn't work." And I sort of scratched my head and I thought, well, that's interesting because that's probably the same person that's the most upset about their insurance premiums going up. And again, I understand. I have a home and I have certain landscaping that I like. And I wouldn't love the idea of having to turn around and clear things around the house by 5 feet. But by the same token, if I'm living somewhere that is in a above average area to burn for wildfire, I have to choose higher premium or clear that 5 feet section. Let's talk a little bit more about what we can do after this break. This is Insurance Hour. I'm Karl Susman. Stand by.
Has this happened to you? You ask 3 different people about insurance and get 3 completely different answers. Your neighbor says one thing, your agent says another, and the internet? A total mess. No wonder so many Californians are confused about what their policies actually cover. That's why the Insurance Consumer Guidance Society exists. ICGS is a nonprofit independent resource created to help you cut through the noise and understand your insurance options with confidence. Their licensed experts don't work for insurance companies. They work for you. They'll walk you through premiums, exclusions, wildfire requirements, and more. Even help you make sense of those long renewal notices that feel designed to overwhelm you. So whether you're a homeowner, a renter, or caring for a property in a high-risk area, ICGS gives you the clarity you deserve. Visit icgs.org for free unbiased guidance. Please consider supporting ICGS with a donation. Your generosity keeps this service accessible to Californians who need it the most. ICGS, here for you.
Hello. This is Insurance Hour with me, your host, Karl Susman, the host with the most. That's from an old TV show. If you know what that reference is, I appreciate you. Listen, remember, I need you to support our sponsor, the Insurance Consumer Guidance Society. You'll find information on them at icgs.org. Without their support, there will be no Insurance Hour. So please, take a few moments, go to icgs.org, become a sponsor, give us a couple of bucks, set something up recurring if you want to, but do something because we need your support to keep unbiased, accurate, insurance-related information coming. And that is what I am endeavoring to do. If you want to reach out to me, you have questions, please do. The phone and text number is 559-656-0317, or send your questions in to questions@insurancehour.com. Of course, you can also go to insurancehour.com, more information there and all that good stuff. All right, listen, we were talking about what can we do to save money on our insurance. We talked a little bit about what we can do for our car insurance, a little bit about what we can do for our home insurance, but there's one big thing that I missed that I want to be sure that I say to save money on your home insurance, and that is your deductible. This is a big one. Now, let me ask you a question. I don't know your finances. I don't know you at all, as a matter of fact. But if there were some type of a loss to your home, could you out of pocket $500? Hopefully. What about $1,000? Hopefully. What about $5,000? And you might be pausing and saying, whoa, $5,000, I don't know that I could just write a check for that comfortably. Okay. So let me ask you, if you did not carry insurance and some type of a loss happened to your home and it was under $5,000, would it be something you would fix? Or would it be something that you'd be comfortable leaving as is? You see where I'm going. What about a $10,000 deductible? And what the point I'm trying to make is you have to remember there are financial ramifications of putting in claims and having an insurance company pay money. They're designed to be there for when the worst happens, for when the fires come that take your house down to ashes, for when something happens during a storm and your roof gets a hole in it and massive damage happens on the inside of your home. They're there for the liability coverage in the event somebody's suing you for something that they believe you're liable for. These are the big ticket items that your policy is there for. You should not be looking at it as a home warranty policy. I can't tell you Well, I will though. Over the last 30 years, I have had lots and lots of people call and say, is this covered? And it's a maintenance issue. I actually had somebody call and ask if the homeowner's policy would pay to clear out their weeds. I swear, I'm not kidding. That's not what they're there for. They're there to cover sudden and accidental loss to your property. Those are the buzzwords, sudden and accidental loss. And if it's not major loss, then you should not be looking to file the claim. And what that means is put a higher deductible on your policy and save on your premium. It might freak you out to see those high deductibles because you're thinking, oh my God, I can't, that's gonna really hurt if I ever have to out of pocket that money. I get that, but you're not, hopefully, going to have a loss every single year. Hopefully you'll never have a loss. If you follow some of these recommendations for home hardening, for example, you will not have a loss anywhere near as frequently as your next door neighbor who might not be doing those things. So raise those deductibles and be sure that you have the appropriate coverage in place once your deductible is met. Okay? Take the time, review your policy, see what that deductible covers, see how high you can comfortably get it. We're going to move on to something else. Now, it's interesting because there's been, on top of wildfires in California, there's been a lot of wet weather, let's say. And wet weather brings lots of questions because we're always trying to understand what's the difference between water damage and floods. Because what is a flood? A lot of water. So how is there a difference? Well, turns out there's a really, really big difference. Water damage has to do with water coming in from the outside, let's say during a storm coming in through the roof if there's damage or something like that, or a pipe that breaks. Flood damage is rising water. It starts from down and it comes up. It doesn't start from up and come down. Now, as far as what is going to pay for these types of events, a homeowner's policy, most of them, will cover water damage events. However, they specifically will exclude flood damage. Flood has to be covered under a different policy, guess what it's called? Flood insurance. It's going to be covered under a flood insurance policy. Now, flood insurance can be purchased in one of two ways. Little known fact, you do not have to just purchase a flood policy from the feds. Does not have to be that way. You can purchase a flood policy through a private insurance company. Most of the time, the rates with the private companies are significantly less than they are with the National Flood Insurance Program, with FEMA's NFIP that it's called. So look around and say to yourself, well, if I think there could be the potential for water damage and flooding, then I should have coverage for both. Look and see what those options look like, what they cost. You might say, well, I'm not in a flood area, air quote. Well, what is a flood area? What do you define it as? Because I can tell you some that'll blow your mind. There are homes that are nowhere near hills. They are nowhere near the ocean or any other body of water. But guess what they are near? They are near, I'm not kidding, a land-based high reservoir of water, a tank basically. You may have seen these when you're driving on the freeway. Guess what? If that thing pops, if it breaks, homes were going to get flooded. So lenders are requiring flood insurance for people that are in areas that could be impacted by those basically large elevated tanks of water. Who would have ever thought? Well, of course, the banks would think so because they're concerned about protecting their collateral for the money they're lending you for that house. So point is, you need to be aware of water damage versus flood damage. And if you don't think you're in an area that could be impacted by a flood, you might be shocked to find out that you could get a policy for under $100 a year. And you might be saying, but why would I do that if I'm not in a flood area? And I'm trying to make the point that there's no such thing as a flood area. Any home, anywhere, could be impacted by flood damage. What you don't want is to be in a situation where you don't think it's flood damage, the insurance company thinks it's flood damage, and now you've got a problem. Cover yourself. If you're so sure that you're not in an area that could be impacted by a flood, the chances are the policies are so inexpensive, it'll be a, well, why not? And just cover all of our bases. Look, that's how I think about these things anyway. I would not want to be in a situation where I'm deciding what an insurance company would cover or not cover. I would rather cover all of my bases and know that in the event of in the event of a claim, I have all of the options that I want to have. One more segment to go. 60 seconds and we're back. Insurance Hour with me, Karl Susman.
Have you ever opened a letter from your insurance company and felt your stomach drop? A canceled policy, a sudden premium spike, a long list of terms no one speaks in real life. Most Californians don't realize how fast their insurance situation can change until it already has. That's where the Insurance Consumer Guidance Society steps in. ICGS is an independent nonprofit organization that helps you understand what's really going on with your coverage before it becomes a crisis. No sales tactics, no company agenda, just licensed experts who explain your options in plain English. From homeowners and renters insurance to wildfire zones, hazard requirements, and everything in between. So the next time a letter arrives and you feel that jolt of panic, you don't have to face it alone. Visit icgs.org to get clear, reliable guidance you can trust. And because ICGS is a nonprofit, your donation helps keep this vital service free for Californians who need it the most. ICGS, always by your side.
Hello. This is Insurance Hour with me, your host, Karl Susman. Thank you so much for being here today. Quick housekeeping. Remember, this show would not be possible without the generous support of the Insurance Consumer Guidance Society. That is a nonprofit designed specifically to help you understand your insurance policy and make informed decisions. They sponsor this show. They make it possible. Please offer them your support. Visit icgs.org for information. One other thing I want to make a point of. I've been in this industry for a long time, 3 decades plus, but you never know it all, and things are constantly changing. If there's one thing I hope you understand is that you never know it all. And even if you did, by tomorrow, something will change. So I do the best that I can to give you the most accurate and up-to-date information, but I'm only human, and I might make a mistake. So if you hear something that seems to be in direct conflict with what you believe to be the case, or what you've been told by somebody else, by all means, reach out and tell me, because my goal is to get you the most accurate information, not to prove that I'm right. So if you hear something, say something, shoot me an email. Just send it to questions@insurancehour.com. Give me a call, shoot me a text, 559-656-0317. Let's talk about it. I want you to let me know so I can let everybody else know. I actually enjoy, I know it's crazy, but I do, learning about new insurance-related things. So if you have something to contribute that I have gotten wrong or missed, by all means, let me know. Okay, final segment. Fraud. I have to tap on this because I'm starting to hear stories and it's worrying me. Whenever there's a situation where there are lots of claims happening, unfortunately, a lot of bad actors start coming out and a lot of people that are out there trying to take advantage. You need to be extra careful whenever there's any type of a large-scale insurance-related catastrophe, because when that happens, people will come out of the woodworks. It's kind of sad, but it's true. They get really crafty. You'll get emails from people claiming to be public adjusters. You'll get emails from people claiming to be contractors. You'll get phone calls from people claiming to be part of your insurance company or their adjuster or an inspector. You need to just be a little more careful. And I say you need to be more careful when there's a large-scale event, because that tends to be when these bad guys really start ramping up their activity. But I hear about it all the time. Let me give you some tips. First of all, the government does not reach out to you and offer you money. That's just not a thing. So if there's been a large-scale event and you start getting phone calls, texts, emails that say, hey, click here, you're eligible for money because of the recent blah, 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 you should immediately raise an eyebrow like Mr. Spock and say, fascinating. Because again, the government is not that kind of generous. They are not going to be reaching out and offering money to you. Stay tuned to reliable sources and only follow up with what they tell you. Don't look for outreach of giving money. Think about it, kind of makes sense. How many times have you ever had someone come to you and throw money at you for nothing, right? That's number one. Number two, if somebody is coming to do an inspection, quote unquote, on behalf of an insurance company. First of all, they need to make an appointment. They need to reach out to you first. Nobody should show up unannounced. Now, sadly, this day and age, you would not want to let a random person into your house or onto your property unless you knew at least who they were or verified why they're there. I've heard stories of people dressed up like public utility workers that want to case houses and they're walking around trying to get an idea of what's there to be able to come back later and break in. I've heard stories of people that will show up claiming to be inspectors for insurance companies, and they have nothing to do with an insurance company at all. They are simply there casing the house, trying to get an idea where they can get in, when they can come back. They'll walk in the house, they'll see if there's an alarm, they'll see if it's being used. This stuff happens. And sadly, and scary, it happens with more frequency than you might want to believe. So if someone is claiming they're going to be part of your insurance company and they're coming to do an inspection, you need to look at that with a jaundiced eye. Maybe reach out to your broker first. Maybe reach out to your insurance carrier first. If they are at your door and they did not make an appointment, that's a big red flag for me. And I'm in the industry. If somebody showed up on my front door and said, hey, I'm with XYZ insurance company, your rate's going to go up unless you let me come in so I can verify you've done blah, blah, blah to your house, I'm looking at them and I'm thinking, really? Actually, what I would probably try and do is keep them at the door while I call the cops, because I know, being in the industry, that's not a thing. But at any rate, I can actually tell you a story about one of our clients that had an inspector come out that claimed they were with the California Fair Plan, claimed that they needed to do an inspection. Not only were they not, but the consumer chased them off their property with a gun in hand. Now, I am certainly not recommending you do that, but I'm telling you this so you're aware that these things really do happen and they really can escalate in very, very scary ways. So don't be a victim of insurance fraud. And insurance fraud is not just a matter of people putting in fraudulent claims. It's a matter of people being taken advantage of because they have an insurance policy. And because rates are what they are right now, because the industry is in such a state of flux, people have insurance on the brain. And these bad guys know it. So if you get a phone call and you were told that, hey, you know what, I can come and install a water shutoff valve for you and you're going to save 20% on your home insurance. Well, the best lies have a little truth. You can usually save money by putting a water shutoff valve on your home, but I certainly would not run around giving anybody a percentage, and I would certainly not just call up or just show up to do it if I were offering that service. Check with reliable sources, protect yourself, protect your property. A little bit of common sense goes a long way. With that, we have come a long way. We are at the end of the show. I want to thank you all for listening. We will be back to talk again soon. Any questions, feel free to reach out, 559-656-0317. This is Insurance Hour. I'm Karl Susman. Thank you. I do want to thank all of you for taking the time to listen today. I know insurance is not necessarily the most sexy concept. It is important that you understand what it is you're looking for, what it is you think you're getting, and finally, what you actually did purchase. You simply need to know more than you used to. Things are more complicated. If you have any questions, please reach out to me directly at 559-656-0317. You may also send your questions to questions@insurancehour.com. Informing, educating, and entertaining, one policy at a time. This is Insurance Hour. The show is dedicated to Shamrock Papa.